Can Alibaba continue to dominate the Chinese market? Welcome to the Valuation Masterclass case study, where you'll learn about interesting stocks and how to value them. What's interesting about Alibaba is that its combined value of transaction is twice that of Amazon. This is Andrew Stotz of the Valuation Masterclass. Let's get started. Remember, this is for information purposes only. It's not investment advice or recommendation. So let's look at Alibaba. It is an e-commerce company from China with the largest gross merchandise value at about $1.3 trillion. There's three things to know about the company: shifting to new retail strategy to drive the top line. Number two is new retail strategy provides growth but comes at a cost. And three, non-traditional segment hurts profit but could turn big. Key statistics: there's 34 analysts covering the company, and it's a 62% upside with a buy. You'll see why there's a 62% upside in a moment. The PE is about 16 times, not paying any dividend right now, and our estimate is 107. That's an 18% upside, so it's still a buy, but much less upside, and you'll see why in a second. Sales, well, the revenue breakdown for 2022, 69% came from China, commerce, and then international, 7%, local consumer services 5%, and logistics 5%. That's the breakdown of the core commerce segment. And then there's the other segment. So Alibaba's ecosystem summary is looking at customer management, which is Taobao, and direct sale. The main driver is the Chinese commerce segment, and customer management, the e-commerce platform, and direct sales, which is also considered e-grocery. Then you can also see logistics, local consumer services, and cloud. Now, let's talk about the speech, a speech that crashed the share price. Here we can see the share price back in late 2020s. Jack Ma gave a speech criticizing China's banking system as being inefficient. Of course, Alibaba had been setting up its own banking operation. The speech led to the Chinese government's realization that China's big tech were wielding a huge amount of power. The Chinese government responded with an immediate cancellation of Alibaba's fintech arm, Ant Group's IPO. Following this cancellation, Ant Group's IPO, Alibaba's didn't go through. There was regulatory crackdowns, there was threat of delisting, and there was, of course, the zero COVID policy. And as a result of all this, the share price crashed by 70%. It was brutal. And this is part of why analysts have such a huge upside, because they've seen the share price fall so much. They're sticking with their prior valuations, and they haven't changed them yet. And I suspect that they'll be downgrading over time. Now, recent updates on Alibaba: Ant Group is now regulated as a financial holding company. There's no plans to revive the IPO of Ant Group, and Alibaba currently holds a 33% stake in Ant Group. Hong Kong Stock Exchange has approved Alibaba's primary listing. Gaining a primary listing in Hong Kong would make Alibaba eligible to take part in Stock Connect with mainland China. This would give access to qualified mainland Chinese investors to access Alibaba's shares. Now, what's interesting really about this is the way China basically hammered on the tech companies in the past. And I would argue that part of that was that they saw how much power the tech companies had over the political system in the US when they even banned the president. So I suspect there was a little bit of retaliation saying, you can't do that in China. We won't allow the political machine to be subordinated to the tech giants. That's just my philosophy, my idea. What do you think? Now, let's go into Ant Group. Ant Group's main business involves providing investment and insurance products, platforms for individuals and underserved small to medium-sized businesses. Ant Group runs Alipay, which is a leading digital payment platform in China. Anybody who's been there knows that's Alipay. They also run Yubao's, an online spare cash management platform where users' spare cash gets put into a money market fund, generating return for users. So let's look at the story. I had mentioned story number one was shifting to new retail. Let's look at that. Alibaba's subsidiary Sun Art, Tmall, Supermart, and Fresh Hippo are instrumental in driving the growth of the new retail strategy. The concept is to integrate online retail with offline retail. Today, all of Alibaba's subsidiaries, physical supermarkets and hypermarkets are integrated into the Alibaba platform. This enables a less than 1 hour delivery to customers through Alibaba's ecosystem. And this direct sales is, a serious engine of growth. We can see the red bar in this chart shows that China commerce retail revenue has been rising steadily up until about 600 billion Chinese yuan in 2022, and we expect it to continue to grow. And direct sales already accounts for 45% of China commerce segment in 2022, compared to just 16% in 2019. This explosive growth was driven by the pandemic. And digital grocery sales in China reached nearly $200 billion in 2021 and is expected to almost double by 2025. Alibaba's smart supermarket also provides greater access to fresh food items where consumers can scan the product's QR code and find out when it was delivered to the supermarket, and a factor that underpins future demand due to preferences for freshness in Chinese culture. Let's look at number 2. New retail strategy provides growth, but it comes at a cost. Alibaba's traditional driver of revenue growth has been its e-commerce platforms. By being the facilitator of exchange between buyers and sellers, Alibaba's traditionally has low inventory costs for its revenue, just like Amazon as an example. The revenue growth of direct sales in 2022 grew by 8%, while customer management contracted by 10%. So the consequence of increasing focus on direct sales segment is that increase in cost of revenue that comes with operating supermarkets. So it hits the margin. Alibaba affirms their focus on the direct sale. From page 138 of the 2022 annual report, they said, as we continue to invest in direct sales businesses, globalization, local consumer services, user acquisition and engagement, user experience and infrastructure, we expect our cost of revenue will increase in absolute dollar amounts and may increase as a percentage of revenue. That's a bit of a warning. And there's a decline in gross margin, and we can see it happening. We're forecasting now is that it probably will maintain stability at about 35%. And with the expected increase in the role of direct sales, I expect the gross margin to be lower in the future from where it has been in the past, but basically flat from 2022. Now let's look at this non-traditional segment and how it hurts profits, but could turn big. This is point number 3. The investments in buildings and building a robust ecosystem has supported growth of the new retail strategy. However, if I look at this table from the annual report, we can see this comes at a cost of profitability, as most of non-China segments are making losses. In fact, as of 2022, only the cloud has turned a profit with an EBIT margin of just a mere 2%. So the losses are reflected on the erosion of the operating margin. Here we can see the EBIT margin going from 20 down to 10. The EBIT margin has consistently been on a decline, and the rebound of EBIT margin is expected to happen once non-China segments start turning profits, but that could be a while away. We don't expect an uptick until 2024. So let's look at the forecast. Consensus is bullish. There's 34 analysts. There's a 62% upside. Most analysts are bullish, and analysts predict lower gross margin compared to the historical average, which we can see is pretty similar to what we're saying. This is in line with our forecast due to Alibaba consolidating subsidiaries with higher inventory costs. So let's run through the financial statements. The P&L, well, expect slower near-term growth due to zero COVID lockdowns disrupting supply chains. Let's look at assets in the balance sheet. Expanding its ecosystem means continuous expansion of net fixed assets. What about liabilities? Well, low debt levels means it has room to leverage up to expand its ecosystem. I guess that's a good bit, that it's not over leveraged. Let's review a couple ratios. Alibaba is still not expected to pay dividends in order to continue pursuing growth. And net cash means it can fund massive growth ahead. If you want to learn how to value companies like this, join my 6-week online valuation masterclass bootcamp, where you'll learn practical valuation skills. You'll get access to my tools, tips, and tricks, and you'll join a group of inspiring financial professionals and get a job through my network of financial industry leaders. Check when you have time to join. Well, the next bootcamp scheduled for October 10th to November 18th and January 9th in the beginning of 2023. If you're watching this video, you get an additional $100 off. Just scan this QR code or go to valuationmasterclass/bootcamp and use the coupon code YT22. Now, back to the valuation. Let's review the A-Stot's investment research stock picking checklist. This was inspired by Peter Lynch's book, One Up on Wall Street, where he talked about 10 baggers, meaning stocks that go up 10 times. We did extensive research on 10 baggers and found 9 factors that drive long-term share price performance. So we have this table to ask the question, can this company be a 10 bagger? Well, let's go through the checklist. Number 1, management is committed to growth. That's a good. Over the past 9 years, revenue grew at a CAGR of 38%. Number 2, growth can hit double digits. That's good. The company can resume double-digit growth once the government ends the zero-COVID policy. Number 3, gross margin can remain high. Well, that's a weak one. The drop in gross margin caused by consolidating subsidiaries and high inventory costs is a problem. If we saw that starting to turn around, that would be a good sign. Number 4, earnings are predictable. This is a bit weak. It's subjected to regulatory risks and other variables that we've seen in the earnings. Number 5, efficient at deploying assets. Well, this is also weak. The asset turnover is below 100% right now. Not that impressive. Number 6, cash conversion cycle is low. This is good. Cash conversion cycle is actually negative. Number 7, cash flow is consistently positive. That's good. Alibaba delivered strong operating cash flows over time. Number 8, capital is readily available. This is good. The company's net cash, and they have access to funding. And number 9, valuation is reasonable. This is good. The company trades lower on PE and price to book compared to its peers, and a lot lower than where it was in the past. So what is the company's 10-bagger potential? I would say it has a potential to be a 5-bagger over time. So let's look at the free cash flow and expect CapEx to remain high. But the free cash flow of the firm obviously is at about almost 94 billion Chinese renminbi. So let's get into the value estimate. These are my assumption. I expect the same revenue growth, but slightly lower gross and EBIT margin. And the terminal growth rate that I'm using is 3% due to Alibaba still having, pretty long growth runway. And I'm using a free cash flow to the firm method. What's my valuation estimate? 107, that's an 18% upside. On the bull side, it could get up to 25%, and on a bear estimate, it could get an upside of 11%. So basically, even in a bear case, it's got a upside there. So what are the risks? Well, the key risks are Alibaba operates in an increasingly complex legal and regulatory environment in China, but also geopolitical tensions might prohibit foreign investors from investing in the company or cause some other issue that foreign investors run away. And synergies between subsidiaries might not be successful. So let's wrap it up. We can see the 3 things to know about the company. I see it as a buy at this point. So my question to you is, can Alibaba continue to dominate the Chinese market?